Good afternoon, and thank you very much for this opportunity to present here. I'm very happy to be at this conference and looking forward to all the feedback from all the different domains represented here. The usual disclaimer applies. The views in this presentation are my own and not of Federal Reserve Kansas City or the Federal Reserve System. I will be evaluating the impact of bailouts on risk-taking of ongoing institutions in this paper. This is as opposed to evaluating the impact of bailouts on institutions that have already been rescued or bailed out. This follows from theoretical literature that states that bailouts affect risk-taking of institutions primarily through the ex-ante expectations of receiving them. I make use of a natural experiment which involves the discontinuation of bailouts to savings and loans institutions in 1989 following an institutional change. What is interesting about this particular change is that it represents a change in de facto resolution methods in the midst of a crisis. Typically, resolution methods tend to change at the culmination of a crisis after new regulation has been passed. And when we are trying to form when institutions are trying to form expectations about future resolution methods, if a new regulation has already come in place, they are trying to form these expectations of policies that have not yet been implemented. However, that is not the case here. Because the change occurs in the midst of a crisis, ongoing institutions are actually able to witness how treatment of failed banks changed before and after the change in policy. There are two main broad findings from my paper. Firstly, I find evidence of model hazard effects of bailout expectations in particular. I also find that risk shifting from equity to debt holders serves as a mechanism for this additional risk taking. Now, the findings from this paper also have implications for some recent regulations, such as the Orderly Liquidation Authority under Title II of the Dodd-Frank Act, which tries to curtail model hazard effects of bailouts, primarily by signaling that bailouts will no longer be available in the future in the event of failure or crisis. Now, this paper shows that the internalization of such signals of no bailouts being available by shareholders is going to be important for such policies to be successful in curtailing model hazard. This is just to provide a brief background about the time period that I'm looking at. I'm looking at a change that took place in the midst of the savings and loans crisis. Now, this graph shows the number of failures of thrift or saving and loans institutions from the mid-80s onwards, and so the period from 1984 to 1992 can be thought of as the period of the savings and loans crisis. And as you can see, the policy change that I am studying actually happens at the peak of that crisis in 1989. So what happens when a thrift institution fails, or what happened when a thrift institution failed? It became the responsibility of the Federal Savings and Loans Insurance Corporation, or FSLIC, which was both the insurer and the resolution authority of the industry, to take a decision on pursuing one of three possible courses of actions. It could provide assistance, which it was authorized to, and enable the failed institution to continue functioning as an ongoing concern, so essentially provide a bailout. It could arrange for a purchase and assumptions transaction, which is essentially the acquisition of the failed thrift by a healthier institution. Or it could arrange for a deposit payout, which would involve liquidating the institution and paying out the insured depositors the insured component of their deposits. Now, FSLIC itself was declared insolvent in 1986 because of the severe stress in the industry and for having to deal with the large number of failures in the industry. Attempts were made to revive the institution by providing it with additional funds. However, these attempts themselves failed, and on February 6, 1989, one of the first proposals made by the then newly sworn-in President George H.W. Bush was to replace FSLIC with the Resolution Trust Corporation. And in the very news item that announced this potential change, even in the New York Times as of the next day, it was indicated that the RTC would only be authorized to arrange purchase and assumptions transaction and deposit payouts. It would no longer be allowed to provide assistance or bailouts. So this graph here shows the distribution of failed thrifts and the resolution methods that were used to resolve them from 1980 until 1993. And as you can see, there's a clear change in pattern from 1989 onwards, from when assistance was no longer provided. Prior to that period, assistance was regularly used as a way of resolution. So there are two main questions that I answer in this paper empirically. Firstly, did bailouts to thrifts induce moral hazard effects? And to answer this question, I will be studying thrifts that are already distressed and looking at whether they increase or decrease risk-taking relative to healthier thrifts. The second question that I will be answering is there evidence of risk shifting from equity holders to debt holders? And in order to answer this question, I will be looking at differences across risk-taking between stock and mutual thrifts. So I'll start off with the first question. Did bailouts to thrifts induce moral hazard effects? Now, if we think about an ideal experiment to answer this question, we would want to look at differences in changes in balance sheet composition of thrifts at a high versus low probability of failure. And we would want to look at this difference before 1989 and after 1989 and use a difference in difference method, for example, that is commonly used in the literature. And the underlying assumption here is that the thrifts at a high probability of failure are the treated group. They are the people who are more likely to respond to a policy that only affects failed institutions, only because they are closer to the event of failure. Whereas thrifts at a low probability of failure would be the control group by virtue of being far away from the event of failure. They are less likely to respond to policies that affect institutions upon failure. However, this kind of question doesn't fit very neatly into a standard difference in difference type of framework. To begin with, when we think about classifying these institutions into the treated and control group based on probability of failure, there is no one way of making that classification. Do you decide that institutions at a probability of failure of 90% and above are high enough to qualify to the treated group? Or would that cutoff be at 80%, 50%? There is no unique answer to that question. There are multiple ways of answering this. Secondly, the way in which this categorization of groups is made, that is based on level of distress, is not independent of the final outcome of interest, which is the decisions made on balance sheets. Now, this kind of independence or exogeneity is an important assumption in standard difference in difference methods. Thirdly, a standard difference in difference method requires assuming parallel trends in the evolution of balance sheet composition of the two groups of institutions. Now, that is arguably a very restrictive assumption to make. So I actually address this by developing a Bayesian estimation method, which proceeds as follows. So firstly, the method generates these two different clusters or groups of institutions that respond differently to policy change. Secondly, I go back and look into whether these clusters have been formed on the basis of underlying risk. And if that is indeed the case, I go back and see how the response differs. So the main outcome of interest here is the year-over-year change in balance sheet components. So I will be looking at the balance of each asset type as a ratio of total assets. And from that, I will be subtracting the equivalent ratio from 4 quarters ago. So the way that my model works is as follows. I will be looking at the population of all active thrifts in the United States after having made exclusions such as thrifts that have already failed, those that were acquired, or those that have been acquired or acquired another institution. And these institutions are clustered using a statistical method called latent class model into two groups. So what we feed into that model for this clustering to occur are long-term averages of financial ratios. So we refer to one of the groups as the treated group, the group that responds more strongly to the policy change as the treated group, and the other group as the control group. Now, we then go on to measure risk-taking for both of these groups of institutions before and after the policy change. And at that point, the variables that we feed into the model are financial variables from previous period, state and county effects, and thrift fixed effects. So now we go back and ask the question, what actually are the components of these two groups? Did the groups get formed on the basis of how risky they were, and as a result, how close to failure they were? From my results, I find that the answer is yes. So the grouping has occurred on the basis of existing levels of risk. So my next question is, if yes, then how did the two groups respond differently? How did the group of banks that were closer or which had a higher probability of failure and those at a lower probability of failure change their risk-taking before and after the policy change? So in order to answer that question, my main measure of interest is the treatment effect, which is going to be the difference in risk-taking before and after policy change for the treated group, from which I will subtract the same measure from the control group. So there are two possible directions in which thrifts that are at a high probability of default can respond to the policy change. If the moral hazard effect is more dominant, then this would indicate that thrifts would have taken on a lot of risk while bailouts were still available to them. So they would reduce risk-taking when bailouts were eliminated. Alternatively, if the franchise value effect is more dominant, then thrift institutions would have taken on less risk when bailouts were available in order to protect their franchise value. And they would have actually increased risk-taking after these bailouts were eliminated. So in my results, I find that moral hazard effects actually dominate franchise value effects, because I find that thrifts that qualify the definition of being high risk and therefore having a higher probability of failure, such as those with concentrated credit risk, higher proportion of volatile liabilities, and lower securities. They also happen to be larger in size, though that is not directly a measure of risk. These kind of institutions respond with an increase in the composition of safe assets and a decline in the composition of high-risk assets, such as construction and land development loans. They also show a decline in the composition of what I have referred to as high-risk liabilities here, basically more volatile liabilities like brokered deposits. So this basically graphically represents what I just showed. This shows the components of the two groups that got created, basically the treated and the control groups. If we look at the set of institutions that decreased their composition of construction land development loans, these happen to be institutions that had a high concentration of credit risk. They had a low securities ratio. They had high ratio of volatile liabilities. They also happen to be larger. And if we look at the group of institutions that increase their composition of securities, it's largely similar to what we saw previously. They have high concentration of credit risk and lower concentration of securities ratio. In this case, they also happen to be larger institutions. They have lower volatile liabilities. Now I move on to the next question of whether there is evidence of risk shifting from equity holders to debt holders. In order to answer this question, I will be looking at differences across two different types of institutions, which is stock and mutual thrifts. So here I'm going to be looking at stock thrifts as the treated group and mutual thrifts as the control group. And because stockholders have investments that can be whose risk can be shifted to debt holders. So this is more in line with the standard difference in difference type of analysis, and I will be measuring the average treatment effect just as I had shown previously. So what I find here is that stock thrifts actually increase their holdings of securities and decrease their holdings of multifamily real estate loans. They also happen to increase their holdings of construction and land development loans and investment in real estate. But I will show the overall impacts on the balance sheet. Okay. So this is the counterfactual analysis that talks about what if the stock thrifts in my sample had behaved like the mutual thrifts in my sample. And I find that overall they would have held $4.5 billion fewer securities, and they would have lent $2.14 billion additionally in high-risk lending such as multifamily real estate and commercial and industrial loans. So in conclusion, I find that expectations of bailouts do influence risk-taking. I find that shareholder expectations of future bailouts is important in addressing moral hazard. I also develop a new method to study policy changes. Thank you.